Hello, I'm Adrian Ashton, and welcome to this video session about finance and accounts. Now, you'll notice that the title of the session is perhaps a bit unusual, reading the financial runes. That's a very deliberate choice of word. Runes, of course, being an ancient token, a hieroglyph form of communication, form of language and writing. Which if many people look at runes today, they go, oh, that's a bit odd, can't really decipher that, hard to get my head around it, not really understand what the code is to decipher this stuff. And I have an idea that for many of us today, when we look at a set of accounts, be they charity accounts or company accounts, it feels quite similar. It looks like we're looking at some weird ancient language that we need an expert archaeologist or wizard of some kind to help us decipher and understand what they mean. And I think that's because actually we don't feel as confident in our ability to do accounts as perhaps we should. And that stems from our confidence in our ability to do maths. Or this is my idea. So if you're watching this, if you're watching this on your own, you can join along in person. If you're watching with a group of colleagues or other trustees or trustees to be, and you're all feeling brave, then join along as well. So what I want to ask you to do is have a think about your ability to do maths, okay, and how well you think you can do maths and how confident you feel in your ability to do maths. Now, put your hand up if you feel your maths ability is not that great. It's not as good as it should be, or it could be, okay? Now, I'm going to make a prediction here that for most of you, if you haven't put your hand up in person, you've thought about it. Okay, there was one or two people who actually naturally excel at this kind of stuff, but for most of us, my experience is we don't feel that great at doing maths. And that's a shame because maths underpins everything we do. And actually, in terms of accounts, charity accounts, or any other form of financial statement is underpinned by basic maths. And what we're going to try and do through these sessions is just to try and show you how true that is and how straightforward it can be to start to approach a set of accounts or a budget to make sense of it. Now, I have an idea because the other question that some of you may be thinking now as well, okay, but why is it so many of us don't feel that good at maths? Why do we doubt ourselves? Well, I've got another idea about this. And I need you to regress yourself back in time to when you were at school. Okay, and amongst other things, particularly think back to your maths classes at school. And remember how much you struggled to do trigonometry, algebra, long divisions, simultaneous equations, multiplications of fractions. You know, most of us struggle to do that. No shame in that. And then think back and think, how did the teacher make you feel? Okay. And my sense is for most of us, we were made to feel like we were rubbish at maths because we couldn't get those concepts. But then since we left school and have gone in our lives, how many of us have actually had a practical day-to-day regular need for trigonometry or algebra or cosines or sine equations or all that other stuff? I'm guessing and I'm betting most of you who are watching this haven't, like me. And as a result, our confidence in our ability to do maths is dented. But as we see when we go through these sessions, all you need to know is some basic maths: addition, subtraction, maybe a bit of division as well along the way, but quite simple. And we'll take you through with the examples as we go through as well. So this first session in the series is just to give you how do we actually make sense of these accounts or financial statements, as they're sometimes called. So we're going to introduce you to the cash flow, to the income and expenditure, or the profit and loss as it's sometimes called, and a balance sheet. Now, I'm not going to make you create these things. We're just going to take you through the concepts of them, how they work in practice, and why they're relevant, why you need them as an organization to make sense of what you're doing. But first, another quick question, another quick quiz, really. I want to take you on a quick tour to a museum in Paris called the Louvre. Some of you may have been fortunate enough to be there. Some of you may be fortunate enough in the future to go and visit that. And in particular, there was an exhibit in the Louvre, which you come to, and this kind of clay ball thing with some bits lying around the bottom. And it's called a boule. Okay, and you can go, okay, well, That's pretty. It looks a bit like a brain, perhaps, or people dancing. It's 4,000 years old, so 6,500 years old. What's this got to do with me understanding about accounts? Well, what it's got to do with accounts is this is, in terms of what I've been able to find at least, the earliest example of an accounting system, of a bookkeeping practice that we as a global society, as a global species, came up with and were using. Now, the fact it's in a museum means that there were things like this that predate this, but for at least 6,500 years, we've been doing accounting systems and practices between ourselves. And that means that we've spent at least 6,500 years getting to the point where we are today in terms of how we approach doing cash flow, balance sheets, income and expenditures, profit and loss. Okay, so even if once you've gone through these sessions and you go, okay, I get the point of these now, and this, I see the point of them and I understand how they work, but surely it would be better to do it this way, present it this way. You may well be right. Unfortunately, the Bula here shows that there are 6,500 years of history that you're going to have to get through to change the way we do it. So it's not here to be defeatist, to go, oh, you just got to put up with it. But I have an idea that if we understand how something has come to be, it makes it a bit easier to engage with it. So just as we're going to go through and help you understand how the accounts of your charity have come to be and how you can approach them, so this idea of the format that we use as well, how that came to be, makes it a bit easier for you to wrap your head around as well and get a handle on it. And if nothing else, it's always nice to have an excuse to have a little sidestep into a museum from time to time, because I think museums are cool. So these financial statements, I mentioned there were 3 of them. Let's knock them off in turn. So the cash flow. Cash is king is the adage in a lot of small organizations. The cash flow is the financial record that shows your organization when money comes in and when money goes out. That's it, like a bank account. Really? Have we got enough money for when we need it, to pay wages, to pay the suppliers? That's what the cash flow is there to help us determine. Okay? Can we remain solvent? That's it. Because as soon as we run out of cash, if we haven't reached an agreement with the bank, everything stops. So cash flow is really important for keeping things going day to day. The next statement that we look at, traditionally called the profit and loss, but in many charities sometimes refer it to the income and expenditure. So this is the annual summary, the snapshot of a year as a whole. And what this does is, this is different to the cash flow in some ways, because this, rather than give it the week by week, day by day, or month by month record, it just says, these were the figures for the year as a whole. So over the year, how much money came in from grants? Over the year, how much money did we pay out on tea bags? Well, what this also does as a financial statement as well is it takes out some of what I would call the funny money. Okay, so for example, if the charity buys a helicopter, because helicopters are cool, right? Charity buys a helicopter and he buys it for cash. Okay, so the helicopters cost £100,000 and it had the money in the bank. So, and the cash flow shows that's it, boom, £100,000 goes out of the cash flow. The profit and loss or income and expenditure statement doesn't show £100,000 being spent, because the conventions we have, those 6,500 years of history, have come to mean that we've adopted a convention called depreciation. Depreciation says in that annual snapshot, profit and loss or income and expenditure, we only capture the spend of how much of the helicopter we used. So let's say, for example, that we assume the helicopter has a useful life of 10 years. So the convention of depreciation and the accounting legislation says that means we can claim 1/10 of what we spent on the helicopter each year. So the cash flow shows £100,000 going out, but profit and loss or income and expenditure says we only show a cost of £10,000, because that as much of the value of the helicopters we used, there's still some left over that we're going to use next year. So we'll come back to depreciation a bit later as well. But this is useful because this helps to give that big picture view. How have we gone over the year? So cash flow is great day to day, but sometimes we can miss things going on because we're so focused on the fine detail. The profit and loss gives us a bit of a bigger view to say, actually, where are the big ticket items happening? And then the third version we have, the third one is called the balance sheet. Now, the balance sheet is the long-term view, the really long-term view. What's it all been worth? How has this shown what we've done over the year has contributed or subtracted from the overall value and worth of the charity to keep going in the future? It helps build a more strategic picture of the relative strengths and exposure that the charity has to different types of risk from a financial perspective. But again, we'll come to that as we work through some of the examples in this session, and then in a future session as part of this series as well, we'll actually go through your charity's set of accounts and talk about some of these in practice in terms of an applied way, so they're not quite so abstract. That's the concept of these things. Now, that sounds great, but what do they look like in practice? Well, some short visuals here, just to help you guide you through this. This is what it looks like, a cash flow can look like in practice. A bit like a household budget sheet, really. A bit like any kind of tracking money when we're saying, well, when does money come in and when does money go out? That's it. It can be as simple as that. It doesn't have to be very complicated. If your charity is using a software package like Xero or QuickBooks or Sage or something else, this is still the same principle that the software is built on. Each week or month or quarter, when does money come in? Where does money come in? How much is that overall? And underneath, how much has gone out? And you'll see as we go through that bottom line on this grid as well, the closing balance. That's really important because that's the bank balance. That's the available cash in real time as we go through. Because it may be that you have some months where there's more money being spent out than there is coming in because a grant has been delayed, or it's simply a quiet time of the year in terms of seasonality. But there are still wages to be paid. So there are some periods where expenditure is greater than income. Essentially, we've lost money this month, but that's okay, as long as overall there is enough money in the bank, that closing balance, to carry the charity through into the next day, week, month, quarter. Okay, so that's the idea of that. Now, again, then an income and expenditure summarizes all that into a snapshot. What have we spent over the year? So add all these costs up over the year and this idea of depreciation as well. So again, that along that side, you'll see some particular bits highlighted that say, well, rent, that kind of makes sense. Insurance, that kind of makes sense. Interest, there's a few bits we've highlighted there on that sheet, just to draw particular attention to, because accounting conventions have slightly funny things that go on in them sometimes. So interest and loan repayments are the two things here. So let's say, for example, that the charity has borrowed some money at the start of the year. It's gone to Charity Bank or Residence or one of the other social investors and taken a loan, okay, taken a social investment to help support its cash flow. And it's agreed a payment plan for that. And it knows it's done some budgeting and forecasting and says, yep, we know we can deal with that and bring it back. Fantastic. So the cash flow shows all of that loan repayment, all that loan amount coming in a big chunk at the start of the year. Fantastic. But our income and expenditure doesn't show the loan coming in because the loan is not part of our normal income. The loan is simply money we've borrowed that's got to go back. So we don't include it as the money coming in at the top of this document, at the top of this account sheet. It's funny money. Similarly, the loan repayments we make over the period. So in our cash flow, so for example, if our loan repayments are £150 a month, some of that will be the capital amount, the original loan we're paying back, and some of that will be the interest that we pay back. So let's say as we split that, of that £150 repayment, £10 is the interest and £140 was the capital amount, the original loan bit that we're paying back. And accounting conventions say that the interest, those £10 of interest, we can claim those as a legitimate expenditure cost because we're servicing that commitment. But the £140, the actual capital, we can't make that appear in our costs here because it's funny money. We haven't counted the money coming in. And the principle behind that is because as an organization, accounting conventions assume that you are not going to be constantly borrowing money to keep yourself going year on year on year. That's unsustainable. That's very dangerous, very risky. So accounting convention says you separate those bits out. So again, we'll look at those as some examples of, as we go through a set of real accounts in a session later on in this series. Now, the balance sheet. Okay, so for those of you who've ever looked at a balance sheet and gone boss-eyed, it's absolutely fine and understandable. They are really strange things to get your heads around sometimes. So what we've tried to do on this slide here is explain visually what a balance sheet is with as simple as words as possible and without any numbers. Okay. Now, just to kind of put a balance sheet in context, just as something that I think, if some of you will know this track as a song track, if you don't know it, I would commend you to go out to YouTube and look it up. There's an American prog rock band called Talking Heads, okay, very big in the 80s, Talking Heads. One of their most famous tracks is called Once in a Lifetime. Once in a Lifetime, great track regardless. And I have an idea that Once in a Lifetime is Talking Heads' ode to the balance sheet. They wrote a rock song about the balance sheet. Bear with me on this, okay? Because the lyrics of Once in a Lifetime go to the lines of, you may wake up one day, okay? So you're here, you're at the start of the balance sheet, the overall figure, you're there, and you may find yourself in a beautiful house with a beautiful wife and a beautiful car. And you may ask yourself, how did I get here? And this is the point of the balance sheet. On one side of the balance sheet are the assets that the charity owns. The beautiful house, the beautiful wife, the beautiful car, all the things that the charity has in its name that has worth. Cash in the bank, the helicopter, buildings, money that people owes it. Okay? All the stuff that has value and asset. Remember the lyric of the song then? The lyric of the song then goes on, and you may ask yourself, how did I get here? And then that's balanced out. The story is balanced. The balance sheet is a story. We have all these great things, the helicopters, the money. How did we get them? How did we get to be there? These are the liabilities. What bills haven't we paid yet? What money did we borrow that we still need to pay back? Okay, so it's that balancing. That's what's called a balancing sheet. It's a balanced story. What's the charity worth overall? What's its financial strength and position for the long term? How is that made up, and how did it come to be there? Okay, so that's it. And now, again, all this sounds a bit abstract. So what we want to do in these sessions is take you through a bit of a worked example, just to start to see how this works in practice. So I've got a little worked example here for you, just to take you through. And this worked example is based on, we're going to open up a corner shop. Okay, and it's a very simple premise. We're going to open up a corner shop, and in that corner shop, we will sell baked beans. Nothing too grandiose there, but it's an essential staple, that's fine. And our story, in terms of this business we've set up between us, this initiative, is that we've gone at the start of the year to the cash and carry, and we've bought a whole tray of 10 baked beans, and that tray cost us £1, so 10 pence per tin. By the end of the year, we'd sold 7 of those tins, and we've managed to sell them at 35 pence a tin. Now, depending where you're watching this and what your background is and what you normally spend on a weekly shop, you may be thinking, 35p for a tin of beans, that's a bit expensive. Or you might be thinking, wow, that's really cheap. 35 pence a tin at the time of recording this video, which is late 2020, is the going rate for a supermarket own brand tin of baked beans. Okay? So that's where we kind of base the price. So that's the story. Corner shop, baked beans. Bought some, sold some. Fantastic. So how does that work out in terms of our financial statements? So let's start first with the cash flow. What does this meant in terms of how our project ownership has run? So let's say at the start of the year, we were a new thing. There was nothing going on. And we weren't able to apply for any grants to help get us going. And we couldn't get any credit from the cash and carry because we're a new business or a new project. So we borrowed some money. We borrowed the £1 from someone. So we took a loan. So the cash flow shows £1 came in as a loan, and then the £1 went out to the cash and carry to buy the stock. Over the year, or by the end of the year, we made sales. 7 tins, 35 pence each, means £2.45. So £1 in, £1 out is 0. and then the sales of £2.45 means we have a bottom line figure in our cash flow of £2.45. Fantastic. But that's not the whole story, because we have these accounting conventions, because that cash flow captures everything and everything going on. What we need to do to work out what's really been going on, or a bit better, is to do the profit and loss, or the income and expenditure account. Now, if you think back to a bit earlier on, a few prompts back, we talked about saying, well, the income and expenditure, the profit and loss only counts what you did materially in that period. What was the operational activity? Take out all the exceptional items. So don't worry about loans and things that are coming in. Just think about what was the core operations. And the core operations of our corner shop said, well, we made sales. We sold tins of baked beans, so we count that, £2.45, great. And we record what we used. Not everything we spent, but what we used. And what we used was 7 tins of baked beans. We bought 10, but we didn't use all of 10. We didn't need all 10. We only bought, so we bought 10, but we've only used 7. There's 3 left over. So the profit and loss, the income and expenditure says, don't worry about those 3 tins we haven't used yet. Only count what you used. So 7 tins. So sales of £2.45, cost of sales, the materials of 70p. Everything else was run on volunteers and goodwill. Means we made a profit or a surplus of £1.75. Hang on a minute, that's different to our bank balance, our cash position. Yes, it is. This is why accounts can be sometimes confusing. Hold on though, because we've still got the balance sheet to go through, and that will really kind of spin things out a bit more, but then we'll try and make sense of it all. Now, the balance sheet, this is the big view. This says, okay, let's look at everything we haven't heard about yet and everything we've maybe missed or forgotten. The big picture view. What's it all been worth, and what position are we in as we start the next year? The balance sheet says, well, actually, our starting position is we owe £1. We have creditors. People have given us credit. We've borrowed some money. We haven't paid that back yet. So we've got an outstanding debt already of £1. Because remember, from the cash flow, we had £1 that came in. We haven't paid it back yet. So we've still got that to pay back. But in terms of paying that money back, paying that lender back, we do have some assets, some things of value that we can do things with, that we can say, okay, great. We know we can cover that. We've got some assets, some stuff we can use. We've got the cash in the bank, £2.45. Great. Okay, £2.45, brilliant. Oh, and we've still got those 3 tins of baked beans on the shelf as well. They're worth money. An accounting convention says we value them at what we bought them for, the cost price, not the sale price, the cost price. That gives us £2.75 there, which means that our net assets are kind of our less the money that we owe is £1.75. But whoa, that's still not quite finished yet, because this was a corner shop, right? Nowhere in our cash flow or profit and loss have we seen any record about the rent that we're paying on that shop. And that's because when we started the year, we had a discussion with the landlord who said they would defer the rent for a year. So we wouldn't have to pay rent for the first year, but it would back up. We'd have a rent kind of deferment period to help keep us going. So we've still got that outstanding bill, a liability, an unpaid debt, an unpaid bill that's kind of come in, and that's £1. But we've still got £1.75 left over after we pay back the loan, so we know we can cover that. So our final bottom line, so when people talk about what's the bottom line on your accounts, this is the number that they talk about, is 75p. This is what our opening up a corner shop, selling tins of baked beans, has been worth in the long-term future. So we've got 3 numbers there, 3 sets of financial statements, crucially 3 perspectives. And this again is helping us understand the principles of how these things come to be put together, but the importance of what we use them for. Because what we use them for is to say the cash position helps assure us as trustees, the charity is solvent, the charity can pay its bills. Okay, we're not going to run out of cash. That's fine. We need to know that. The profit and loss, or the income and expenditure statement, tells us how sustainable is what we're doing. Are we generating a surplus from what we're doing each year in some way? And if we are, that's great. And if we're not, well, how are we trying to cover that? How can we have the confidence that things have been structured properly as activities and programs? And then finally, the balance sheet. What's the long-term prognosis of our charity? What kind of future do we think we have when we start to do some forward planning? When we think about risks, how strong a position are we in from a financial perspective to deal with whatever the universe throws at us next week to go through? So that's why we have these different statements as we go through. So that's the principles, the ideas of financial statements and accounts. But it gets a bit complicated if you're a charity. And we'll kind of pick on this when we look at some worked examples of your own charity's accounts. So what I've done there in terms of taking you through cash flow, income and expenditure, or profit and loss, and the balance sheet is these are the basic principles, the basic models of them. For a charity, charities also have to apply to some additional accounting reporting. And the main one comes in two words: restricted and unrestricted. So when you're reporting cash or income and expenditure, then charity law says the charity has to show in its accounts how much of that money is restricted, that you were given that money for a specific purpose. Okay, we had a grant, but we could only spend the grant on planting trees. So it's restricted. We can't spend it as we need to. We can only spend it on planting trees. So that's restricted income. So we show it as restricted. And then we've got some donations, spending what we want. So our cash flow, our income shows this is our restricted income, and this is our unrestricted income. And then we've got our total income. So we start to get a sense of, we may have loads of money here coming in, but how flexible and responsive can we be in how that gets spent? Okay, so it's great, but restricted income is for particular activities that are planned and budgeted and pre-agreed. Unrestricted income is the magic stuff that you can spend however you need to, when you need to. Okay, so it's important to draw the lines between them. Just because you've got cash in the bank may not mean you can spend that however it needs spending. There may be restrictions, so always worth checking. Also, as charities as well, there is another convention that charities need to prepare their accounts to, called SORP, the Statement of Recommended Practice. And every few years, just like with governance codes, as we looked at in a previous set of videos, they get reviewed and updated. But just like with the governance codes we saw in some of the other sessions in this series, they are differentiated. There are different SORPs for different sizes of charities. So if you're a small charity, the regulations, the additional detail that you have to put into your accounts and how you report them is light touch. It's quite simple. The bigger you become, the more that detail gets laid on, the more you have to put in to make it work. So again, if you've got a good financial management system, good bookkeeping system, you've got some bookkeeping support, a good accountant coming in alongside you, or you've got someone you employ as the finance manager who's really good on this, they can guide you through that as trustees. Make sure you understand what are we needing to report against this particular standard and framework. So those were a couple of other bits we wanted to put in as well, just to put that forward. So we've understood the concept of why we have these financial statements, what they mean in practice. Well, what's the point of having them? They show we've got money in the bank. That's a good thing. Let's crack on. Why do we need to dig into the detail of looking at these things and understanding them? The reason you have to do it is because it helps you better understand how the charity is performing. Is the charity as stable, as solvent, as secure as it could be? How do we know how well we're doing as a charity? We're looking at our accounts and it seems okay. Well, again, back to the Bula at the start of this session, 6,500 years ago, all charities prepare their accounts in the same way. So part of your role as a trustee, when you're looking at accounts, might be to say, well, okay, in terms of the surplus we're making on this, in terms of the amount of money that we spend on staff against the income we've got, is this right? Are we doing it properly? You can go to the Charity Commission's website. You can find comparable charities to yours by activity or by size, look them up, and you can view their accounts, which will have been prepared in the same format as yours. So you've got a like-by-like comparison. Not to say that your account should be like theirs, but it gives you a perspective, it gives you a benchmark. So you can be more confident about how you've understood it and what actions, if any, you think you need to take as a result of them. And this is why we kind of labor the point why accounts are so important for you as trustees to get your head around. You don't have to be an expert accountant or auditor or bookkeeper. You just need to understand these basic principles. And then, as I said before, as we go through the videos in this series, you start to pick out, how do you approach them? What do you look for? Where are the flags? Where are the good signs? How do we start to make sense of them? So ultimately, in terms of this aspect of your role as a trustee, you can be more confident, you can be even better, you can be even more brilliant as a trustee doing it forwards. So like I said, this is only one in a series of short videos we're doing about accounts and understanding accounts. This first one has been about how do we get our head around these different things, formats they come in. Why do we have these different formats, and how do we make sense of them? What's the point of them? The other videos we've got in this session are a bit of a kind of a checklist approach. So there's guidance from that the Charity Commission put out that say actually there are questions about your accounts that the Charity Commission feels that you as charity trustees should be able to answer. Then that's how you know you're on top of it as a trustee. So we'll go through that in another session. And then we'll also have another session where we get your charity's actual accounts and we'll go through page by page what they mean, how to cross-check them, and the sorts of story that you then start to understand from these mystic runes that are the accounts. So hopefully there's been something that you've found encouraging, something of interest, something new. Ultimately, I hope that through this initial session as well, you now don't feel quite so scared about the prospect of looking at accounts as you did at the start, and that you can actually, maybe not enjoy it is the wrong word, but be able to engage with it more constructively in the future. So I've been Adrian Ashton. Thanks for listening, and bye for now.